Welcome back to Let's Talk Tax, the show for growth-minded CPAs and real estate professionals navigating the world of tax with clarity and confidence. Let's get started, Jason.
Yeah, good to be here.
You ready?
I am.
In our industry, with what we do, the few things that really pop are obviously 174 fix, bonus, permanent. A lot of things like that have been coming up. I think the little hidden sauce here is in your area, so with international tax.
It is.
I know we want to talk about a bunch of stuff today, but why don't you just give a quick overview inside the bill? What are some things, updates that we need to be looking at? And then we can kind of go into some scenarios and discuss a little further.
No, I appreciate that, Tim. And I would agree that most things in OB3 are not international related. So a lot of times this kind of falls off people's radar screens. But I would say some of the key things to keep in mind is that the Tax Cuts and Jobs Act did have a significant shift. And this bill kind of builds on that. So it's not going away. It didn't go away. And it won't for the foreseeable future. So the reality is we need to now plan for some of these, I would say, minor adjustments and keep those in mind. And then some of the other provisions that maybe have a wider impact, to just be aware of those given the other focus in the bill and some of the things that kind of drive our CPA firm partners to think a little more with their clients on a general basis. Because like 174 has been a struggle for so long, it's at the top of everybody's mind.
You're right. Yeah, that's the thing. It's the big pain points have been fixed.
Yeah.
So everybody, that's like their sole focus with that. But I think we got to really kind of open up to the whole bill and say, all right, what are some of the areas that we need to look at? What are some of the planning tools that we can take out of this, especially from an international tax standpoint? Obviously, the current administration, they're wanting to pull money and business back to the U.S. So I think there's going to be some planning opportunities there. So why don't we just start with one of them that I think is interesting, because we actually talked about this the other day. Let's kind of jump into was GILTI.
Yep.
Okay, and now is...
We're referring to it as NCTI.
NCTI.
Yes.
Okay. Okay.
So we
are we the ones that made that up?
I don't know.
Okay.
I kind of thought it was that. Maybe there's a different pronunciation, but I'm going with that for now. Similar to OB3. I mean, I guess we'll just see what happens if it develops in the market as something different. But essentially, the world of GILTI, just to take a quick step back, is general taxation of offshore earnings currently, and that under the NCTI or net CFC tested income, NCTI, is still there, and it's still a taxation immediate of offshore profits. The thing that changed is some of the percentages changed, the base changed a little bit, the deduction percentages, but the overall concept is the same. So the effective tax rate used to be about 10.5%. Now it's somewhere in the 13% range. So again, it's something to keep in mind, make sure clients are aware of it. The reason for the name change is it gets a little bit more honed in on what the actual calculation and some of the terminology in the calculation. So it's not so arbitrary as GILTI kind of referred to with that acronym.
Can you give me a quick scenario of when NCTI is going to come into play?
Sure. Yeah. So the easiest thing to think about is if you have a U.S. company and they're forming an entity, say in Germany, for example, they're going to expand into Europe, they're going to use Germany, and that German entity has income or profit inside of the company that's subject to tax in Germany. So under the old rules, meaning pre-TCJA, that income wasn't taxed in the U.S. until it was brought back, except for some special circumstances. Under GILTI and now NCTI, it's taxed immediately, and then when the cash is actually brought back, it's not taxed again. So it's more of an acceleration of taxation, not a deferral under the pre-TCJA rules. So again, the concept is still the same. Terminology is a little different, and the math is a little different, but it's the same idea.
Okay. Not to. We're going to just kind of move along here.
Yeah, absolutely.
The other one I think we need to talk about is FDDEI, right?
Right.
Okay. Let's walk through FDDEI.
So FDDEI,
because that one's up here too.
Okay, I'm just to bring it down a little bit lower for you.
Appreciate it, Jason.
Okay,
I think all of our listeners are going to need that.
So FDDEI is just an incentive for exporters, and it's a deduction that they get. It's actually a similar deduction and calculation to the GILTI or NCTI deduction we talked about. They changed the nomenclature of the name now, so it's FDDEI, so there's an extra D in it now, and it's just a different percentage. So it more accurately describes what happens, but it's still in a situation where you have a C corporation, so an entity that's taxed as a C corporation in the U.S. that has export sales. That's a benefit that they can get. So if you have clients out there, if our listeners have clients that have export sales, it still is. The good thing about this bill from an international perspective is it made permanent some of the things we were wondering about. And what could there be a big change? There wasn't. So now we have more certainty on planning for the next several years.
Okay.
So I think the idea is if you have companies and clients that are expanding, let's make sure we look at NCTI to make sure we understand structuring. If you have clients that are exporting outside the U.S. to another country, which is kind of what the goal of some of the administration is right now, to be able to look into some of these benefits under FDDEI as well.
Okay, so if I'm looking at FDDEI, because I'm hearing you say export, and obviously, you know, I listen for triggers. That's what I do.
Yep.
So I hear FDDEI. Can you tie an IC disc with FDDEI?
You can.
Okay.
Yeah, so IC disc is a different export regime, and they can run concurrently in a C corporation structure. Typically, we see IC disc more in a flow-through structure to individuals because it's more obvious the benefit, but it also can happen in a C corp. So you can get, I wouldn't call it double benefit, because it's different calculations, different way it works, but in essence, you can kind of get a duplicate benefit on export sales.
And I don't know if you can elaborate on this a little bit. I know we've got a lot of the things to talk about, and I don't want to focus on IC disc just because the FDDEI thing is bringing me to that.
Right.
Well, if we look at an IC disc for C Corp, kind of help me understand why we would be setting that up for a C Corp and what the benefit could be in that situation.
Yeah, so the C Corp benefit is typically you have situations where the owner is taking out earnings or something else as salary or some other tax, it's taxed at ordinary income tax rates. If you set up a disc, you can have a dividend scenario at capital gain rates. So there's a rate arbitrage between the two. It's the same as if it's flow through, except it's just structured a little bit different, but the same concept.
Do we need more export sales for a C Corp than we would do
No,
for
still
flow-through?
2 million or so.
Okay.
Yeah.
So I want to give just a scenario on that. And the reason why is because we're going to get into this at some point here in the coming days. We'll actually have a call on it. I have we have a mutual client.
Yep.
They have multiple taxpayers here in the U.S. So each company in the U.S. actually files its own return. But there is a Swiss company involved that owns the U.S. companies.
Yep.
C Corps, a lot of export sales. Can you navigate the disc in that situation?
Typically, the disc doesn't work very well for foreign owners, but FDI or FDDEI should work for them. So it's one of those scenarios where in international tax, it's very fact specific, and it's always good to ask the question. So you say your triggers, you always want to look for the triggers and then ask the questions to see, okay, does it apply in this fact pattern or not? Because some of these rules, even under the pre-last week, were always fact specific. They still are, and it's not that it may or may not work. It's not always the same answer for everybody.
Okay.
And that's part of the challenge of international tax is that planning component and making sure you have the facts.
Okay.
Yeah.
Okay. Let me ask you this. In the couple things that we talked about, is there anything that we missed that we should focus on before I move on?
No, I think the only thing I would just maybe highlight from what we chatted through is just make sure you understand your client's facts, because that really drives a lot of the planning. So we haven't talked at all about how to plan out of NCTI. Are there different ways that you can have a better tax result depending on the specific structure? So that's always the key, is know the client situation, not only the facts of like entity structuring, but what are their goals and objectives as a company? What are they trying to accomplish, cash management, all those types of things that can really all come together in a nice tax plan.
All right, so looking at all this, and obviously we get on calls a lot with clients. When we're looking at those fact patterns, what are some of the challenges that we face in the communication between us, the client, maybe the CPAs involved, mostly the CPAs involved? What challenges do we face there? Yeah,
I think the biggest challenge is terminology and really understanding the detailed facts. And what I mean by that is, like, what specific entity do they have? Where is it formed? And a lot of times people use generic language like joint ventures or partnership or we're in business with or whatever that case is. And that's not really how you can effectively tax plan. So I think the difference is encouraging and educating our CPAs to ask those follow-up questions so they understand it, or to bring us into those conversations so it's not kind of the telephone game a little bit. Just make it more one-on-one or direct conversations with the taxpayer to understand the details.
Okay, because a lot of this can string out.
It can. It definitely can.
Obviously these projects can be very, I would say, timely, that we need, they're a little bit invasive because we got to get a ton of information. Okay, and we get that. But we've got to be timely, because I feel like we get up to the filings and all of a sudden it's like boom, 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 boom.
Yeah.
So I think that's a big challenge that we face on our end as well.
I agree. Completely agree.
All right, moving on. BEAT.
Yes. We don't run into these very often. The reason we don't is the threshold for BEAT is very high. $750 million of revenue or more.
Okay.
So typically our taxpayer clients in the space that we deal with in the middle market, we often don't run into clients that are big enough to run it to hit a beat issue. But it's basically an extra tax on payments that go outside the U.S. So as you can imagine, the overall administration is trying to focus on U.S. ownership of businesses, businesses doing business inside the U.S. So when people invest foreign, there's some issues there, and including what we'll talk about here, or we can just talk about it now, is the remittance tax. So that's something that's on payments going outside the U.S., which sounds pretty scary. Like, okay, everything is applicable. Some of the initial guidance is like if you have a payment from a bank that's FDIC insured, that's an exception. So I think it's really going to come down to, it sounds scary, but it's only going to apply in a small section of transactions that the government deems as potentially suspicious, not your normal activity. But again, we're waiting for some guidance in that area.
Okay. Are you seeing some sort of uptick in scrutiny when it comes to compliance reporting on international tax work?
Yeah, probably the past 2 or 3 years at least has been a lot more scrutiny on compliance, being complete, accurate, timely, and then something we haven't talked about yet because it's not really in the bill specifically, but the whole transfer pricing world of just
oh my gosh,
all of that being scrutinized as well and being identified via compliance, some of the intercompany schedules. So again, while it's not in the bill, nothing changed in the bill to Section 482 for transfer pricing, it definitely is all part of the same package of making sure we understand our clients' business goals, what they have, and all those fact patterns.
Yeah, I think the IRS is going to have to get smart with their capacity issues, and they're going to have to start using AI.
They definitely are. They are right now.
I think they're faxing things. It's still at some point.
Yeah, it's crazy.
But I think if they do get a hold of AI and they start utilizing it, this is where they're really going to be able to hone in on certain things. And I know they're doing it already for looking for transfer pricing studies. So, on their forms, they're looking for Schedule M's, and I think when they go through Schedule M's, that AI is able to scrub and see if there's any intercompany transactions, right?
Yeah.
And if there are, they can request at that time, they can submit and request a transfer pricing study. And I think you have 30 days.
30 days.
30
Pretty quick.
days. And I don't know, I'm sure we could do a transfer pricing study in 30 days, but with the amount of information that we need, that would be pretty quick turnaround.
Yeah, and the even more complicating factor of that is typically audits and requests come out a year or 2 or 3 after the return's filed. There may be changeover in staff. There may be documentation that's not readily available, financial information. So that also just adds complexity to being able to respond that quickly.
Yeah.
And I'll just say one thing is if you get a notice, don't ask for an extension of time because the IRS knows that means you don't have it. So just be careful on how you communicate with the IRS in that one.
Yeah. So, that's a good point because if they do get a notice, obviously they're going to have to scurry and figure out how to get something completed or if they don't have it, is there an immediate penalty or is there some sort of delay in penalty? Do they give a grace period?
Yeah, once that notice period ends for the extending the IRS notice, there's the IRS will usually come in and assess their own pricing and then assess tax, interest, penalties on any U.S. tax that wasn't paid. And then typically there's no corresponding adjustment on the other side, meaning if there's more U.S. income, you would think the math would say there should be more expense somewhere else, but you don't get a corresponding adjustment in another country because it's a U.S.-based audit. So,
but it probably makes them. They're probably going to then say, you know what? Let's just open everything up.
Yeah, it becomes.
That's my assumption.
Yeah, it becomes a situation where if there can be circumstances where if you don't have transfer pricing documentation, the IRS could easily come in and say, hey, what else aren't they documenting?
Yeah,
it's just one of those things that we typically and we always advise and in most cases strongly advise transfer pricing because it just covers off a potential audit issue. And then also if you have clients that are thinking about a sale and they have sometime in the future and they have transfer pricing documentation available, it just shows that they have their act together.
Yeah.
And it provides more value potentially on a sale.
Well, what's the other tool for transfer pricing? Obviously everybody looks at it as like, well, I'm just being compliant. Great.
Yeah.
Can't we use it as a tool?
We can use it as a tool to be able to transfer pricing and maybe a little level detail is typically a range. So within that range, you can use different pricing in that range that's acceptable to be able to put profit in a certain country, cash where you want it. We not really touching upon tariffs, but that's in a lot of people's minds to be able to impact some of the values for tariffs perspective. Because if you have an intercompany price that's supported by transfer pricing, that also can be used for your customs duties and import pricing. So it kind of, again, all ties together around all the concepts that we're talking about.
So it can be used as a planning tool. I guess I wonder if the companies are sitting here looking, well, we know what our margins are, we know where we're sitting. How many of you got into where it's like, oh no, we didn't just do this for compliance. We actually did support the client for actual reporting and how they were doing all their profit margins and everything else.
Yeah, we've had several times where we've come in and we've done a study towards the end of a year, towards the end of a calendar year, and then help them change their pricing for the year, making adjustments to fit within that study that ends up providing value, not only from a documentation perspective, but value from a cash savings perspective on taxes.
Wow. Okay.
Yeah.
That's great.
Yeah.
That's great. What would be maybe the key things taken from the OB3 to kind of put into the minds of our CPAs and tax professionals out there to kind of help them navigate this?
Yeah, that's a great question. There's a few things that we maybe aren't going to have time to get through that are more, I'd say, technical in nature and somewhat less often found, like some of the look-through rules and some of the other things that were enacted, some of the attribution rules. Those kind of come up in more complex situations. So I would say for the majority of our CPA firm partners, really have conversations with your clients on what are they doing currently, what are they looking to do internationally, bringing in some help for situations that maybe they don't understand completely, to make sure that we're providing good advice and good value ultimately to the clients. Because sometimes when people do it, and maybe same as last year or same as client B and client A must be the same, that often provides a path that is not wise and not tax effective. So I would say use this opportunity maybe to talk to their clients about the other more impactful parts of the bill, 174, R&D, all that stuff, but then use that as an opportunity to also say, hey, there were some changes international, not as significant, but what do you guys have going on there? And use these conversations as an opportunity to kind of bridge both, go across the bridge for both things.
When's the best time to bring something up when their clients haven't been doing something right?
Right now.
After a bill. Here's why we need to talk about that.
Yep.
Right? I mean,
That's
it's just,
right.
it's a good strategy to have because it is. I mean, it's not, you're not, misleading your clients. It's just one of those things where it's kind of been like, well, we've been under the radar with this, but we're not only going to be able to stay there for so long.
Right. Exactly.
Now we have to open this up because this bill is showing us that the current administration's not playing around. They want this stuff in the U.S.
That is true.
Well, Jason, I really appreciate this. Has been great information. I've learned something today.
Okay, good. I'm glad to hear that.
That's the most important thing. If nobody else learned anything, I did.
Hopefully others do too.
Yeah, I appreciate it.
Yep.
That wraps up today's discussion on the international tax changes inside the One Big Beautiful Bill. Huge thanks to Jason Rauhe for unpacking some very technical but extremely important updates. As we heard today, this legislation creates ripple effects across GILTI, FDDEI, Subpart F, BEAT, and entity structuring. Advisors need to be looking at their multinational clients now, especially with provisions taking effect for tax years beginning in 2026. If you'd like to learn more or connect with Jason and the Global Business Service team, visit McGuiresponsel.com or reach out directly. Thanks for joining us on Let's Talk Tax. We'll see you next time.